as I walked out the room last year, I think maybe many of you all were also here, a Malaysian who works for a Singaporean hedge fund actually approached me and said, "Wow, you siao lah, your market going to crash 2008 lah. What are you talking about lah, You think what you're decouple? What are you talking decouple?" I still believe we have another 3 years. If that gentleman is here, I request another year, because I think the market is going to stabilize by end of this year. It's going to gain momentum in 2010, and what we are going to see is a slight upcycle in 2011 and 2012. What I would like to term a mini boom. I'll go on to it as we move on. On the sentiments of the market, right? DJ Elena could not get her immigration visa as usual, our immigration department, so we're still at the Budaba mode. But what we're actually seeing is there is new capital inflow coming. Very little, but it's already flowing in, right? And with this, we see that the approvals would be given towards end of the year, and we see the market picking up again in 2010. Our subprime market is the Along market, right? It handles itself very well. They know how to take care of themselves. I still believe that we would not have been affected by the subprime market if it wasn't for the collapse of the Lehman mini bonds, right? Now, what happened when the mini bonds collapsed? When the mini bonds collapsed, most of our foreign investors, mainly Hong Kong goers, lost all their money. The downturn in KLCC, not from the Pakistani buyers, not from the Middle Eastern buyers, not from the buyers from China, not our local buyers, were Hong Kong goers and Singaporeans. They were throwing the market and that's what caused the dip of 20 to 30%, right? And subprime, I still believe till September, subprime did not affect our market, even now. But what's affecting our market is the sentiment due to investments of quick rich schemes, like the mini bonds and the Madoff Ponzi scheme. Many people think a lot of Asian companies did not invest in the Ponzi schemes. I'm really sorry. A lot of the Hong Kong banks, Hong Kong hedge funds are all caught, right? There's even a friend of mine who works in a French bank, 600 million euros write-off on Madoff's Ponzi scheme, right? So, how it affects our market is the people who have invested in those, they are short of the cash. They are the ones that are selling the market, right? In mid-December last year, in a bout of market negativeness from the whole market, we took a stand. We took a stand that now, thanks to Fung Yee, we call it our brave stand. On the collapse of Lehman and AIG, what we saw in October frightened us. We really thought, that's it, markets are going to collapse. But in November, we saw the market was resilient. The market was strong. And I told myself, if we see panic selling in December, we are done for. But we didn't. The market was strong. And to couple that, what we predicted, that there would be a flurry of launches after Chinese New Year, was also true. And that, coupled with the fact that in February, we confirmed that there was a sale of a parcel of land in Damansara Heights for 610 ringgit per square foot, plus a sale of semi-D in Desa Nusantara for 3.4 million. Basic, not renovated. 3.4 million, semi-D, Desa Nusantara. Vindicated our view that now people would want to invest in real estate and would go for landed properties. Sorry. Soon after that, we were running out of so-called desperate sellers in KLCC. We couldn't. We do a lot of transactions in KLCC, and we couldn't find where the desperate sellers were, because all the opportunistic buyers were already buying out at about $800 per square foot. When we made this statement, somebody approached me. Hey, Previn, how do you all predict KLCC prices? Now I'll share with you a secret. This was told to me by a developer friend of mine. Follow the KLCI. When KLCC was at the peak, KLCI also was 1,002, 1,003. Now markets drop, it's 800, 900, KLCC also 800, 800 and 900. And just to advise you, CIMB Equity Research said by year end, KLCI will be 1060. 20% growth, brother. It's a lot of money, But seriously, I think KLCC took a big whack. I will share with you all why. But as I said, main whack was because of the push in the market by the Hong Kong goers and the Singaporeans. As I said, the Middle Easterners are still holding on because they see value in it. Likewise, the Indian subcontinent and the Chinese investors. But what we are seeing now, and what we saw then in October and now, is that sellers are realistic in their asking prices. Do not think that asking prices make value, right? Asking prices will drop, doesn't matter to me, right? But what we see is asking prices have dropped. Owners are realistic, and buyers, in the good times, buyers don't mind paying 5-10% extra because they say they'll run up the value, they'll make on it on capital appreciation. Now buyers want a fair value. Buyers want to see that they get a fair deal, and they're willing to wait for it. So that's the situation now. Now my contrarian views are because Malaysia is a contrarian story, right? And I think, I use what the valuers love, it's called the comparison method, right? So we compare with what's next door. It's our neighbors, Singapore, right? We never had a general bubble. We didn't have a bubble. What we had was a bubble in KLCC. We are a locally driven market. Only 2% of the total residential transaction is foreign as compared to Singapore's. And this for me gives us a further upside. Now both landed and high-end condos, the growth was sustainable. Now let's compare with US, where every analyst thinks it's the center of the world. Prices actually increased by 100% in 5 years. 100%, 20% per annum average. As compared to Malaysia, where even the better properties, maximum, it didn't even exceed 50%, right? So I think, you look at it, that's why we have taken this stand. The market, how the market's moving is different.